the stage is yours. Thank you, Marvin.
Thank you, Paul. All right. It's wonderful to see all of you guys still here. Thank you for staying. I will try to make this short and sweet and brisk. My name is Marvin, and I'm going to talk about sort of my observations about ecosystems. So Samer gave me a long list of stuff he wanted me to talk about. I don't think we have enough time for that, so I tried to condense all of this. And before I sort of get started, it's been actually a great dream of mine actually to come to Beirut. I've actually been wanting to come here now for close to 20 years. So this is actually the first time I've been in Beirut. And I've been very impressed. The food is fantastic. And I'm looking forward to sort of spending more time here. So anyways, let's kick this off. Who am I? So this is my credibility slide. I live in San Francisco. Been there for about 16 years. A couple of things about me. I'm a partner of 500 startups. I'll talk about that very quickly. I mentor at about 20+ different startup accelerators all across the globe. I sit on a lot of boards and advisory boards, and I worked at Yahoo for about 10.5 years. And so I can pretty much tell you how not to run a company. But anyways, I worked at Yahoo for many years. And before that, I actually worked at a e-commerce startup that raised about $30 million. This is back in 99, 2000. And a couple lessons. A lot has changed over the last close to 15 years now. And if you think about sort of where the startup world is going, reality is it's getting easier. You know why we had to raise $30 million? $15 million went to buy hardware. And remember, we used to have to go and set up our own hardware. Things like Amazon Web Services and cloud services, none of this stuff existed. And so a lot of, think about how much the cost of actually startups has actually declined 1,000 times. I think there was a presentation earlier by the Innovation 2 guy where he talked about the exponential growth of technology. And that has actually, as the computing power increases, you've actually seen the price of it actually decline at the same time. And this is actually a big deal for all of us, at least in the startup scene. So 500 startups. We are a global seed fund. We have about $200 million under management. We've done close to 1,300 investments. I think it's almost 1,400 investments now at this point in time worldwide. We invest in sort of small check sizes, and probably about out of this portfolio, about 30% of our portfolio is actually outside of the US. We've made, I think in Beirut, we have one company, Etobe. Where's it? Paul. Anyways, Paul's one of our companies. So we've literally invested in close to 40 different countries right now, which is, I think, very unusual for a Silicon Valley VC firm. We also have an accelerator that is actually, I think, fairly well known. So I run the San Francisco Accelerator and San Francisco office as well too, besides being an investment manager. And I think one of the benefits of actually investing in so many different companies, we have a massive data sample set of companies, of what works and what doesn't work. And I think one of the things that we've actually found out and why our methodology is so different, we are an early stage seed investor. Why we're so different is we invest in building sort of a large portfolio. And why we think this actually makes sense in an early stage, and our numbers actually bear this out right now, is that for traditional venture capital, you're doing 20 to 30 investments. Unless you're Sequoia or Greylock, most VC funds return no money, actually lose all the money that you put in, because it's really hard. And we think, because we're not geniuses, we think having a large portfolio enables us to get a piece of one of these unicorns or one of these sort of massively successful companies, which is why we focus on building large portfolios, small checks with follow-on afterwards. So this year alone, we did something close to 600 deals worldwide. Just to give you a general idea, our check sizes are about between $50,000 to $100,000. And the methodologies make a bunch of small bets, and as these companies actually grow and do better, we do follow-on investment, $250,000, $500,000 checks into companies that are working, which is actually why we're able to deliver the returns that we deliver. Anyways, enough about 500. So quick thing, we have an accelerator stage, so I run the accelerator in San Francisco and Mountain View, and we also focus on a lot of seed, and we also have invested into a distribution team that works with later seed, what we call post-seed companies, to help them with their growth and distribution. And I believe these slides are going to be sort of like, you don't have to take a picture. These slides will probably be distributed, or I'll put it up on SlideShare or something, or if you have any questions, you send me an email. But the main thing about sort of seed, what is different is that because of this cost of building product, cost of launching companies, it's declined dramatically. We look for different things as investors now, right? Where before, you'd raise $5 million with like no product. If somebody comes to me and they're raising like, typical round that we sort of invest in is between $500,000 to $1.5 million, and you have no product, there's no way I would invest in you. And so what has happened is that you're seeing more and more and more companies pop up, and because of that, you're seeing the traction levels and requirements and the filtering is much higher, even in early stage. So it is much easier to sort of build a product and build a company. It's actually much harder to actually scale it. And so these are a couple of things that we've actually learned. And so we try to work with companies actually in the earlier stage. You saw on the previous stage, if you were here earlier, with some of the other Middle Eastern sort of VCs, they tend to be downstream to us. So they're putting 3 to 5 million checks. They're probably downstream to where we normally come in. All right, so that means they come in later than we do. All right, couple of things, right? So all those things I mentioned, easier to build a product. The challenge now for startup founders is that it's easier to build a product, but it's harder to stand out. And I think one of the big things that has been a development over the last 10 years are there are platforms in the world now that allow you to reach hundreds of millions of people, right? On Facebook alone, you can reach close to 1.5 billion people. Think about that, right? And so there's all these great channels, whether it's messenger channels, Pinterest, whether it's things like Apple App Store, Google Play Store, and this should be huge. I think this is something you should all be excited about, is that you can basically launch a company from anywhere in the world and actually reach a global audience based on where you're at because of these awesome global platforms that we all have availability. All right? I'm lucky, right? I've been in the US now for 16 years. I'm originally from Canada. So I've been in the US now for 16 years. And I think in some ways it's an advantage and a disadvantage. The advantage is it's a big, massive, and growing market, 300 million people, and that's awesome. But the problem about that is just one of the things that I think Americans suck at is actually globalization, because everyone speaks English. It's a big, massive market, and a lot of times they ignore the rest of the world. And I think, if this is an advantage and a disadvantages too in the MENA region, the MEA region, we'll call Europe, Middle East, Africa, fragmentation of localization, right? It's challenging because it's very, very hard outside of, say, Germany or the UK, which have like 60 to 80 million people in their countries. You can build businesses, decent-sized businesses, VC-backed businesses, just in the UK, just focusing on Germany, focusing on China, maybe Brazil. But if you're a small country, whether it's Lebanon, whether it's Estonia, whether it's Sweden, you actually, to be venture capital backed, you have to be thinking regional and global from the beginning. But the good news about this is that all the tools are in place now to build massive business from wherever you're at right now. And so my perspective is, let's see if this works. Here you go. Is that rise of the small, right? Small is beautiful. You think about the most together countries right now, and I think the most entrepreneurial and interesting countries right now would be Estonia, Sweden, right? Finland, Singapore. What's the difference in all these countries? They're very, very small, but they can change very, very quickly, right? They can adapt things very, very quickly. Countries like big countries, Russia, Brazil, India, China, they have the advantage of scale, but when you think about just your ability to sort of maneuver and just to be able to, I just think they're just very disadvantaged on so many different fronts, from a governmental front, and I think being a small country, you can actually move very, very quickly, and you're forced to focus globally or regionally from the beginning if you want to build a interesting business. And I think that's an advantage that Lebanon has as well, too. All right, let's go into this. And one of the things that actually drives a lot of ecosystems as observation is actually the importance of exits, right? And so there's a country that's been very, very close here, Jordan, right? If you look at the startup scene in Jordan, why is there a startup scene in Jordan? Any ideas? It's because of the Yahoo acquisition of Maktub. $170 million went into that ecosystem by buying that company. A little bit much. I was involved in the acquisition when I was at Yahoo. There's a bunch of people who made money from the acquisition. They started investing, and that's why there's actually a thriving ecosystem there. Think about Estonia. Why is Estonia on the map? Estonia's on the map because Skype, I think they got sold twice, right? Skype got sold twice, so lots of money got dumped into the ecosystem. Think about Sweden. Lots of money being raised in Sweden, right? Spotify, I mean, Spotify's raised how many hundreds of millions of dollars. There's actually been quite a lot of small exits and medium-sized exits in Sweden as well, too. And that has actually driven the ecosystem. From the US, example that's close to home is New York, right? New York as a tech ecosystem was nowhere up until 2007. Why is that? Because DoubleClick was bought by I think DoubleClick was bought by Google for $3.1 billion, right? That actually dumped a whole bunch of money actually into the ecosystem. Same thing with Tumblr. Recently, the Tumblr acquisition in, by Yahoo for I think close to $1 billion or $950 million. All these things have actually, by having these entrepreneurs actually make money, number one, it's an example for people in the ecosystem. The second part is that all of a sudden you have a bunch of founders who have money now who are actually angel investing and investing in the next generation. This is incredibly important, right? And that's why it's very, very rare to see startup ecosystems come from people who come from real estate money or iBanking, right? I mean, Wall Street, there's been so much money in New York, and why has, there's literally trillions of dollars, in my opinion, in New York, and from real estate and iBanking, and none of that money went to tech because they don't understand it, right? And I actually think that's a big difference of, if you look at all the ecosystems across the globe, they're all driven by exits. If you have an exit, a very significant exit, that drives more startup activity. So something to think about. Hard to influence, but I actually think it's an important factor. And it's an observation, whether it's in London. If you look at Berlin, why is Berlin such a huge place, right, for startups? Whether you love them or hate them, I don't like them. The Sammer brothers, they should have a statue of the Sammer brothers in Berlin because of Rocket Internet and Zalando. I think they're terrible human beings, but they're awesome business people. And those exits have actually been really, really, really good for the Berlin ecosystem. And they've trained a ton of people in startup entrepreneurism. Like Marco is he is a ex-Rocket Internet. These are the people who are starting the next generation of startup companies. All right. And other important thing that you don't think about, and we're starting to see it start here in Lebanon and in all really, really sort of vibrant ecosystems, it's culture and community, right? The pay-it-forward mentality, being helpful to the next generation. I just see too much of this. And this is the issue of it. I spent a lot of time in Europe. And one of the challenges in Europe is when you go to these ecosystems, like, these people just like, they don't, Russia, I'll use the example of Russia, right? In Russia, if somebody takes angel money from one angel, other angels don't want to touch it. It's this very, wait a minute, you took money from that guy. I don't like that guy. I'm not going to work together with him. I'm going to put in my own event. I do not think about the environment. I'm going to do my own thing. Screw these other guys. And so there's this like internal sort of like view on fighting over a piece of the pie instead of actually thinking about how you actually grow the pie and work together and growing the pie together. The reality in Silicon Valley, like, we have rivals, all right? We all have rivals. There's some people we don't necessarily like, but nobody hates each other enough to sort of like, to treat each other badly. And the people who are bad actors in the valley, they get booted out. Because most people, like, nobody hates each other. You work together to sort of grow the ecosystem. And if you are a bad actor, you actually get expelled and you get excluded. And that's one of the things that I see with the vibrant ecosystems, that people work together, right? Whether you're investors, whether you're actually startup founders. And, for example, like, we compete with Y Combinator, right? Like, we have an accelerator, we compete with Y Combinator. We also invest in Y Combinator companies. We invite them to our talks, right? And vice versa. And so I think that's one of the things, that you never have any enemies. You always want to be thinking about, especially as your emerging ecosystem, how do you grow the pie? How do you all work together to grow not just your share of the pie, but actually grow the entire sort of like piece, not just fight over the piece of the pie, but grow the entire pie so you all benefit. And I think that's missing in a lot of emerging ecosystems of the I want my piece and I'm not going to help other people, and that's actually not how you win. All right. Next slide. And so, I talk about culture, right? And culture of actually accepting failure. So Drew Houston, he's a co-founder of Dropbox. Don't worry about failure. You only have to be right once. I think the reason why this culture of sort of accepting failure is actually really important is because if you think about most startup entrepreneurs, is that they have to take a lot of swings at bat. Sorry, that's the US term. But in baseball, taking a lot of swings at bat, right? Because most startup founders, if you look at their background, it's very, very rare for startup founders. It's, if all the good ones, it's incredibly rare for somebody to start a company and they're successful the first one. A lot of startup founders have actually done multiple startups. They've pivoted. And so this acceptance of failure is actually incredibly important, but it's about taking a lot of swings at bat. You're going to have a more likelihood of actually success. And investor ecosystem, it's gratifying to see there's starting to be some VC ecosystem. I think what makes a very, very vibrant ecosystem are investors all the way from angels, early stage, all the way through to later stage. that's one of the challenges of actually investing in this region, investing in Europe, investing particularly in Latin America. I mean, I'd say Southeast Asia is a little bit different because there's actually quite a lot of like money coming in from Japan, and there's a lot of later stage investors. But I think one of the things that's actually missing in most ecosystems is actually angels, so-called angel investors. And I think one of the things I see a lot in coming out of this, we've done a lot of investments in this region in Europe of just angel investors. The problem with a lot of angel investors that are not from tech, and so they come from real estate, iBanking, they come from the old world industries of like, I invest money in this factory and I have this sort of like physical material. So and they don't understand that in startups, it's actually all about the founders and all about the IP. And so the reality is that if you put in some money into a startup as an angel and you take 50, 70% of the company, you've screwed that company. That company's going nowhere. And you go like, wait, that doesn't make any sense. Because all of a sudden, as they're raising more money, let's say they go to raise money from one of my VC friends here, the VCs are gonna be looking at it going, wait a minute, this cap table is screwed up. Because the thing is that I need to own a certain percentage as an investor. I want to own 15, 25% of this company. But if I do that, then that's going to be taken maybe from this other investor share, but a lot of it's going to be taken from the founders. Like the founder is not incentivized if they own 20, 30% at the seed stage to take this business and make it massive. Because you're like, the more investment I raise, the more I'm going to get diluted. And so wait a minute, like, even if I sell this business for like $100 million, like I'm going to make $1 million after working on this thing for 10 years, like I must just go get a job on Wall Street and make way more money. And so that's one of the things that angel investors and investors do not understand. And I think it's something that even startup founders, like I've seen this, I was in Turkey, and I don't mean to blame Turkey, it's just like, they're like, well, it's gotten much better now, right? Angel investors, like now they only take 50% of the company, taking 80%. And it's like, that's still stupid. And that's actually part of the reason that ecosystem is stillborn. So anyways, investor ecosystem is incredibly important. Just because you have a good idea and a good ecosystem and good awesome founders, like the money is actually what's important. The capital table structure. My last batch, I had 5 European companies. Every single one of their company cap tables are screwed up. I had to spend 4 months cleaning it up, right? And it got to be such a pain in the ass. If I see a screwed up cap table, I'll never invest. And the reality is that most VCs will not take the time to invest, to go and spend the time to clean up the cap table. And so something, all founders, if you guys decide to go down the VC route, understand the importance of cap tables, understand the importance of valuation. This is important for you as you grow your business. All right? So the main thing is that Silicon Valley, you've heard this quoted, Dave was recently quoted, paraphrasing and quoting Reid Hoffman, who he worked with at PayPal. Silicon Valley is a mindset, it's not a location. And I think it's really true. If you look at Lebanon, I mean, Lebanon has had, I think, thousands of years of real commercial culture, massive diaspora all over the world. I just heard that there's something like 10 million people in Brazil of like Lebanese descent. I mean, there's a lot of talent out there, a lot of people, even the US, lots of Lebanese I know. And just like incredibly intelligent, long, rich culture of sort of like commercial culture. And let's be frank, not a lot of great infrastructure, and frankly speaking, somewhat messed up sort of like region and stuff, but that actually is an opportunity. It's an opportunity to actually start from scratch and to build something that really can have impact, not just in your country, but in your entire region. And I think this legacy of actually commercialism, this legacy of actually trader mentality, right, will do you very, very well, this hustler mentality. These are all great starting points for any startup ecosystem. So I am incredibly excited to see what's going to be coming out of this region, and I would say out of this country over the next 5 to 7 years. And I hope to be invited back next year and hopefully see the improvement here in the companies and such. And I'm very confident that's going to be the case. So thank you very much for your time.